Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm GOVINDRAJ, ETHIRAJ. Now, the third meeting of the Goods and Services Tax Council, a critical step in bringing about the new goods and services tax regime across the country this week, remained inconclusive, as the government has decided now to take more time to finalize a proposed 4-tier rate structure for the tax. Now, the centre and states also differed over the funding mechanism for compensation to states in case of revenue loss following implementation of this regime. Now, the question we are asking is, now that the process is underway, why are these rate structures important, and who gains or loses if they are not set to everyone's satisfaction, and can we better differentiate the larger challenges from the smaller ones? To discuss this, I am joined by Sanket Desai, Director Ernst & Young, Mithil Chokshi, Senior Partner Chokshi & Chokshi, and Nihal Kothari, Executive Director at Khaitan & Company, as well as the Chairman of the National Council on Indirect Taxes at ASSOCHAM. Thank you all for joining me. Mr. Kothari, let me begin with you. So, you've seen this whole process for many years now, almost a decade. So, we are obviously at somewhere close to the end of the is it the first lap or is it many laps? Where exactly are we?
Yeah, actually I am delighted to see the way things are moving at a fast speed, and what dream we had we should have an integrated tax system and in the federal structure. That is going to be reality very shortly. And the way the Rajya Sabha has passed unanimously this, and also subsequently the way decisions are taken with the consensus, it gives a lot of hope that we are on a right path. Now, whether the objective for which the GST has been brought is the issue which need to be addressed, because it has to achieve the objective for which we are going forward. Now, there are three main objectives. One was to make India.
I was about to ask you about that. Yeah. No, go ahead. Yeah.
One is about the making India one common market. I feel based on the whatever so far has happened, I think we are going to reach there. That uniform structure of tax, no tax barrier which are created, even 1% tax, which was a tax barrier, has been removed now. So that is going to be achieved. The second one is to make Indian industry competitive and make more investment, make in India. Now that will be partially done because the way things are moved, particularly after the draft GST bill comes. So unless they correct that, that objective will not be fully met, and particularly some industry will have a serious impact.
And that's because?
That is because, see, the two pillars of GST, that it tax entire supply chain and you give a seamless credit. Now there are credit which are actually withheld. For example, like petroleum product is not part of the GST, the fire product. They are also used in downstream production, they are used in services. So there are several industry which will get affected. Now, if that excise duty or VAT is not given a credit, the cost of those products will go up. So whether it is a packaging material, whether it is a polyester fiber or say those cloth, everything will go up because of the which was earlier available under the existing reason. Similarly, if you have a commercial establishment or say like factory you set up, and that setting up a factory become a immovable asset, then the input in that is not given a credit, even though the services or revenue from that is taxed. So these are the things which need to be addressed. Maybe it is initial stage, but can be addressed.
Okay. So let's look at the rates, right? So 6%, 12%, 18% and 26%. So walk us through what this means and who gets affected by this, Sanket.
Yeah, so to start with, if we compare this proposed 4-tier rate structure with the global scenario, what is happening, because India is not the first country to implement GST. This is already there in more than 150 countries. Everywhere, if you see,
and it's not there in some countries, including the United States.
Exactly. So United States is an exception. But if you look at largely Europe, Australia, Canada, Singapore, everywhere they have broadly a 2-tier rate structure, which is a standard rate and a merit rate. And some countries have a sin tax or a tax for tobacco products and alcohol, so on and so forth. Now, if you compare that with the proposed structure which the central government is proposing, we, as you said, we have a 4 rate structure, 6, 12, 18 and 26. But let me tell you, it's not 4, it is much more than that. So apart from these 4, we will have exempt. You will also have a 4% rate for gold and jewelry, diamond, precious stones. You will also have a cess on certain ultra luxury products like luxury cars and so on and so forth. So it's a 7 rate structure really, if we look at it. It is too complicated. Okay.
Yeah, and I was listening to Harsh Mariwala of Marico say that, he says, I don't think you can have so many exemptions. We're going to say that luxury shampoos could be a luxury category and shampoos could be in another category. Anyway, go ahead.
Exactly. So, so what this will result in is a lot of classification disputes. too many complications. This will not help the Make in India endeavor which the government of India is looking at, and possible solutions which the government can look at to resolve this. See, what is happening today is they want to put a lot of goods in 26% category. Now, if you look at the Chief Economic Advisor's report, he had recommended a rate of 35 to 40% for certain sin goods like tobacco, luxury cars and all. Now they want to put even those sin goods into 26% category. So one way of dealing with this situation is
But would cars be sin goods in other countries?
No, not really.
Okay.
Cars are not really sin goods.
Okay.
In other countries, UK has introduced, has a sin goods concept where
It's more like a carbon tax rather than a...
Yeah, it is more of a green tax or tobacco products for encouraging non-smoking. So those kind of things. So possibly.
So what you're saying is we are starting, our starting point is too unwieldy. We have too many rates and we need to do something right there.
Yeah.
Okay. So let me get in, Mithil. So what's your sense, Mithil, if you were to look at it from a company's point of view? Are we heading into a direction where the administration of the tax itself is looking cumbersome?
Yeah. So again, with this 7-tiered, 7 rates or even complications, again, there are input complications that will step in. Now, just to step back, Australia took 21 months to really install an effective GST system in place. Now again, and it was one of the pioneer countries. Now again, we are not saying that we should take 21 months. What we should do is we should take the learnings from all those countries and identify it and bring it down. Now the ideal
So what would
scenario,
be like 1 or 2 key learnings in your mind?
So key learnings, ideal learning would be we should have a 2 or a 3-tier tax rate. One is an essential commodities, a mid-market commodity and a luxury. Luxury, sin, whichever you call it, and a 3-tier structure, simple structure. Then is the, today what is happening is there is a discussion on 9th and 10th November, the meetings are going to happen for the administration of the dual administration. Now, dual administration is going to create a chaos. It's going to be complete chaos because, I look at it that the legislative policy should be at the center and only the recovery should be outsourced to the state. And they become like a business partner to derive, look at it from a very simple perspective. The controller, the managing partner is your center and your recovery partner is your state, and he kind of pulls the recovery and he shares it with the center.
Got it. So let me come back to you, Mr. Kothari, but that seems to be a point of contention between states and center as well, or amongst other points of contention.
This
and
administration,
yeah,
I think that can be resolved. This is a major issue. The third pillar of this GST was to simplify the tax structure and make it more ease of doing business, and that will be totally lost because of 3 reasons. One is this dual structure. So, and the second is that even though the entire process is digitized, you file return and at the month end you will get a credit automatically. All transactions are there, which will have access to central government, state government, but they will take 3 years to do your assessment, and you have to file a return duly audited by chartered accountant. There is another audit by the department, then there is an investigation, and if they find something more to be checked, they will have a special audit.
So you're saying every company will be
going through this whole process, and then you have 2 authorities, one will differ with other. So you are going to have a serious problem. It's a backdoor. This Inspector Raj is expected. So I think that requires a serious concern. While it is not having a revenue impact, but it will
affect the working
of this and the ease of doing business. If you don't have a certainty, no investor will come from overseas. That is very clear, even if you give a temptation, big market and all. But it's better to import to that market than manufacture with this kind of a problem, because after 3 years, 5 years, you see that you are getting a certain demand which you can't recover.
Right.
So that is a major issue, that if you are having a digital entire system, why not within a month or 2 months, 3 months, you should say that this is your liability.
Right. Okay. So another point is compensation for states. So that seems to be again an issue of contention as we're going into the next round of discussion. Sanket?
Yeah. So on compensation, states have had 2-3 concerns right from day one. The first concern was that the states they had that apprehension that revenue will go down after GST comes in, which the center has duly addressed by way of the constitutional amendment, that they will give 100% compensation for 5 years, which is a big statement, and they have cast in stone in the Constitution of India. The second apprehension of the state was that they will lose their autonomy or the power to tweak with the rates, to change the rates. If you see the last 12 to 18 months, multiple states have gone on to increase their tax rates. the latest, I mean, even if you see the state of Maharashtra, they have increased the rate from 5% to 5.5 and then 6%. So all the rates are increasing.
Which rate are you talking about?
The VAT rate.
Okay.
So all the VAT rates, the states have been increasing the VAT rates in the last 12 to 18 months. Now with GST coming in, the states will not be able to tweak with those rates. That is the second concern. But this is more of a mindset change which the states will have to go through. But the other point which has now come up after this new rate structure proposed is that this cess, the cess which the center wants to levy on this ultra luxury products, it so happens that the entire cess will have to be retained by the center, and the states will not get a pie out of it. And that's where the states have a concern. Otherwise, all other, I mean, even the CGST, what the center will collect, there is a provision that the center has to share a certain part. I mean,
right, but we already have so many cesses, and the government under the Excise Act has the ability to levy those cesses fairly independently, right? I mean, so how does this change?
The point is that if the government, instead of putting a cess, they would have just proposed the higher GST rate. The center would have been required to share a part of that tax revenue with the states. Okay, now so with this cess, they will not be able to.
Okay, so we're running to the end. So let me get some quick sort of sum ups as we go into the next round of discussions. Mithil, what's the way forward at this point? I mean, so you already talked about, you know, like with great emphasis on harmonizing the number of rates. What else?
The companies need to now strategize all their businesses in the context of right from the source to the consumer. And when they look at the source to the consumer, they need to determine what will be my costs. Because today, what are the costs that a company faces? A Rule 6 issue in a VAT, where you will have a trader who's also rendering services, and you will have a potential disallowances, and you'll have 70% and 80% disallowances of those, you know, adjustments. So today, with GST, again, if the same kind of 150% disallowances are going to happen on the tax rates, I think that's where the streamlining will have to be started. The process has to start by each and every company today. Look at it, streamline, considering.
Right. So what you're telling companies is that while all this happens, get your back end in shape.
Absolutely.
Right. Okay. Last word, Sanket, and then
to me,
second
one
last
most
word,
important point which the company's industry has to start working on very immediately, on an immediate basis, is rewiring their IT systems. That is going to be the most.
But are you saying that because you're getting a feeling they're not doing that or not moving fast enough?
Some companies have started that. There are companies like SAP, Tally, who have come ahead and said that we will give you a patch for GST. There is a solution. And some companies may be under the impression that a patch will just come in and it will be plug and play.
Which
it will not be that simple.
So here's the warning for that.
Yeah.
Okay. Last word, Mr.
I think
Bhattacharya.
there is a lot of work has to be done by the company, particularly considering that there is multiple rate structure. The whole system is changing. The credit you will get only if the supplier has paid. So there is a lot of work they have to do. They have to screen the supplier, and also they have to look at entire supply chain to see that they are actually compliant. And at the government side, I think they have to actually interact with the industry more to have a workable solution to the administrative issue at least. And that is where the first time that the government is moving in silos. Earlier, all the reform, there was a participation with the industry and all. But this time they are doing so.
So that's a critical input for the next round.
Critical input, for
the next round. Right, we've run out of time. Thank you so much for joining me. We need to go in for a break. Coming up on the other side, the BRICS summit concluded in Goa recently. What does BRICS really mean, and what can it offer? Stay with us. Welcome back. It represents 43% of the world's population. The much awaited BRICS summit, or the grouping of Brazil, Russia, India, China and South Africa, ended in Goa this week. Leaders attending the summit adopted a 110-point declaration that covered a broad swath of issues, including building common grounds against terrorism and the need for striking a balance between economic development and environmental protection. Now, the summit itself was held under the theme of building responsive, inclusive and collective solutions. The declaration also touched on trade partnerships, helping small enterprises, promoting industrial cooperation and overall cooperation in areas ranging from nuclear energy to space. However, with the BRICS economies no longer showing the same consistent economic growth they once did, the question we are asking is, what kind of place does BRICS have in the world today as a body? How indeed can India benefit from other members and vice versa? To discuss this, I am joined by CRISIL Chief Economist D.K. Joshi and Deepak Prem Narayan, Chairman of First Rand Bank of India, a South African bank, and he's also President of the Indian Merchants Chamber. Thank you both for joining me. So, Mr. Prem, let me begin with you. So, I'm sure you've been watching the BRICS summit. You have a strong foot in two countries, at least in the context of BRICS, that is India and South Africa. What have you seen in terms of benefit, if one can say, in an institutional context, from perhaps a BRICS collective?
A couple of things. The NDB Bank has set a foot in South Africa, and the objective being is to cover the African continent for infrastructure, renewable energy. So that's been one of the major steps. The second thing that I've seen is that in South Africa played a neutral role till very recently on the NSG, and it played between, it parked itself in the middle between China and India. And because of the BRICS interaction and India's growth of business with South Africa, they have now backed India. So that's been a second development. Third is that South Africa, in the context of the countries with the 5 partners which are there, South Africa is important for us, and so is Brazil, because China and Russia have their own agenda. Although the declaration in Goa, as you correctly referred to, that they had some political announcements, it did mention very strongly that they'll follow the norms of UN in terms of terrorism. Security would not be the advantage of another country. But coming back to Africa, so these are, and the African Union, the declaration also says,
touch upon this,
yes, in depth for that matter, that they will work towards the developing markets in the African Union through public-private partnerships in infrastructure.
But do you see this giving a leg up to what you're doing, or would this have happened in any case?
No, this is definitely a leg up. The NDB, for that matter, setting a footprint there for Africa is a leg up. That is one. Partnering African Union. See, these partnerships like BRICS, it's moving at its own pace. There have been positive developments, but they take time to establish. And I'm a firm believer that in any foray, there are many a times, particularly institutions like this, that you may not have meeting minds, but when you keep sitting and talking and negotiating,
something does emerge
so
over time.
Another institution that has evolved over here. So it's a question of institutionalizing BRICS. NDB was the first one. Now you got the rating part of it. That's also
that's I was about to ask DK Joshi as well. Okay. So DK, let me come to you. So we're looking at an interesting situation. Of the 5 countries, that's BRICS, Brazil, Russia, India, China, and South Africa. You have Brazil and Russia clearly in recession mode. You have let's say a country like India and China obviously going strong, and South Africa somewhere in between. So how does this add up as a block or as a collective entity?
Well, part of the reason why we are seeing divergence in growth is because of the commodity price cycle. Many of these countries, particularly Brazil, Russia, they are directly connected to the downturn in commodities. So I think as commodity prices move up, some of the divergence in growth rates will get corrected, and commodity prices looks like are likely to move up, because as the World Bank yesterday also projected that there is an upside to commodities in general and also to oil. But I think if you go back to the basics and look at why these countries were classified together, they were classified together because of their strength of domestic demand and their potential. I think that still remains, and I think once you have the right set of policies and more cooperation, I think going ahead, these countries can again look up, at least the ones that are fledging right now, can look up to better performance.
So, DK, let me ask you a more fundamental question. So, if you look at the global economy today and the fact that things are not going so well, what really is the theoretical opportunity or the construct for 5 such countries to work together?
Well, I think if you're right that I think the world economy is in a weak moment right now, and it has been so for almost 8 years now. And there's no decisive recovery, and there's too much of leaning on easy monetary policies and I think unconventional policies, which itself creates risk to emerging markets because I think once the policies reverse, the capital volatility will rise. So I think one set of issues relates to the risk that is emanating from very easy monetary policies and their unwinding at some point in time. But I think there is a lot to cooperate on, and I think the suggestions that I was at the World Bank IMF meetings in US last week, and the suggestion that seemed to be coming out was that the countries, even the advanced countries, should focus on education, on skilling, and fiscal stimulus, so to say. So I think given that backdrop, and if you look at the needs of this part of the world, I think particularly I think India, if I were to be very specific, I think we also need to scale up our infrastructure, and that is where this the BRICS opportunity shows up, because at least from the financing perspective, the creation of the new bank, I think can address some of the financing issues in a local context, so to say. But I think you need to go a little deeper than that, and I think the infrastructure creation is not just about financing. It's also about the risk that the projects face. And I think that is where we need to address it domestically. And then I think, each of these countries will have to. China is an expert in infrastructure creation. I think it has successfully shown that over the years, and one can leverage on that expertise for other economies as well. So I would see that. I think in the global context, I would say that the countries need to push their domestic demand up, need to create infrastructure. In that context, I think cooperation among the BRICS economies can be really fruitful, because the global headwinds will continue. Trade is already under threat, and the trade intensity of global growth is coming down. So I think countries will have to, and in an environment where advanced countries have also started looking inwards, and protectionism is rising, I think you need policies to prop up domestic growth, and cooperation in this set of countries can definitely help offset some of those risks.
So let me, we were trying to understand, when two countries collaborate, or like India and South Africa in this case, or it could be India and Brazil in this case, something special could emerge, which is perhaps outside what, let's say, a political initiative could be, or a bloc initiative could be, as we are seeing today. If you were to build on that experience, what do you see happening in future?
Well, let's take this particular Goa meet itself. Brazil and India met on the sidelines. Now, Brazil, there were 4 MOUs that were signed, and it had to do with the agriculture side, it had to do with the development in terms of the animal husbandry, reproduction of cattle, etc. And Brazil is strong on that. It had to do with pharmaceuticals, regulation, it had to do with aerospace. Now, so that was a sideline. So this is one takeaway. And Brazil needs a partner also like India. And they see a great opportunity here for their agro-based processed products, amongst other things. So that was one. The second thing is the BIMSTEC, which has fallen in place. So that's another important takeaway. Because you take the 7 countries which have been put together, other than BRICS, which is India, Nepal, Sri Lanka, Bhutan, and the Thailand, etc. Now, as a result of that, they are all growing at about 6.5% per annum. So there is actual growth happening here. There is a consumer offtake here. So this is, as Joshi was saying, that internal growth is one thing, but at the same time, when you're partnering with the right apples also, so BRICS and BIMSTEC, there is, okay, we've got a situation in terms of Brazil's growth today, we've got a major situation in terms of South Africa. So this is another major initiative that came out of this. And what is very important is the recognition that within a short time, NDB, National Development Bank, has disbursed $911 million. And they've given $250 million to Canara Bank for an renewable energy fund. So there is action that has started. And as they say, Rome wasn't built in a day, but I see BRICS within, plus the stance taken that the selection of the UN Secretary General has to be more in a more transparent manner. IMF and World Bank, where globally markets looked at them for funding. Now you've got another horse that is standing up, that is BRICS, which is the NDB. So, and NDB is going to be built up. It's through raising, once the rating gets better, there'll be...
So you're saying that as we create more institutions, that in turn strengthens the bloc itself?
Precisely.
Right. Okay. DK, let me come back to you. So if you were to compare, let's say, the BIMSTEC, which is the regional bloc, versus, let's say, a BRIC, which is not a regional bloc as such, where do you think we should be focusing our attention on?
Well, I think, to me, as far as the trade is concerned, I think multilateral solution is obviously the best one. And but since that is not happening, the WTO doesn't seem to be going anywhere. I think the regional agreements will help, and I think we should align, as was being pointed out, with the economies which in the region which have better growth prospects. And I think doing that, the inter-regional trade, so to say, I think, which is where there is enough potential. I mean, even with the neighbors, I think neighboring countries, I think our trade is dismally low. So I think there is a lot of opportunity in raising the trade or lifting the trade potential or realizing the trade potential in this region. And I think that one will have to strategically look at the economies. I mean, because looks like, I think, the bilateral and maybe some regional trade agreements will be more successful.
DK, let me interrupt you there. Thanks for that last word, Mr. Premran. We've run out of time. So if you were to look ahead, so you said that there are very interesting things happening on the sidelines, or in a formal way, of course, the creation of the BIMSTEC, the creation of several institutions, which in turn strengthen the original institution or the original bloc. Are things looking good and positive from a BRICS perspective for you as a business person in the next 5 years?
Definitely. I would definitely say so, because of infrastructure, because of collaborative effort in the neighboring markets. I see that because India has skill sets to offer as far as Bangladesh goes, Sri Lanka goes, Nepal goes, and Thailand, Myanmar. And recently more forays have happened in these markets. I'm optimistic about this regional, multilateral, bilateral cooperation too.
Right. And you feel that business will benefit and business will grow as these institutions in turn strengthen partnerships business partnerships between companies?
Institutions are critical because you've got tax reforms required, you've got tariffs which are there, you've got customs issues.
Right.
So these are being addressed, but they will have their speed.
Right.
And India is keen to push this hard. And you saw that at Goa. So there were some declarations which were made specifically with this objective in mind on regional economic cooperation.
Right. Well, thank you, Mr. Premran. We've run out of time. Thank you, DK. That's all we have time for in this episode of Policy Watch. We'll be back next week, same time. Thanks for watching.